How to make money online from stocks. The key to making money in stocks is remaining in the stock market. Your length of time in the market is the best predictor of your total performance. The stock market's average return is a cool 10% annually, better than you can find in a bank account or bonds. But many investors fail to earn that 10% simply because they don't stay invested long enough. They often move in and out of the stock market at the worst possible times, missing out on annual returns. Most financial advisors will tell you that you should invest only money that you won't need for at least 5 years. That way, you have time to ride out market ups and downs and still make money. Here are some ways through which you can make money online from investing in stocks. Buy and hold. There's a common saying among long-term investors: time in the market beats timing the market. What does that mean? In short, one common way to make money in stocks is by adopting a buy and hold strategy, where you hold stocks or other securities for a long time, instead of engaging in frequent buying and selling, aka trading. Consider this. The stock market returned 9.9% annually to those who remained fully invested during the 15 years through 2017, according to Putnam Investments. But, if you went in and out of the market, you jeopardized your chances of seeing those returns. For investors who missed just the 10 best days in that period, their annual return was only 5%. The annual return was just 2% for those who missed the 20 best days. Missing the 30 best days resulted in an average loss of minus 0.4% annually. Clearly, being out of the market on its best days translates to vastly lower returns. While it might seem like the easy solution is simply to always make sure you're invested in those days, it's impossible to predict when they will be, and days of strong performance sometimes follow days of large dips. Opt for funds over individual stocks. Seasoned investors know that a time-tested investing practice called diversification is key to reducing risk and potentially boosting returns over time. Think of it as the investing equivalent of not putting all your eggs in one basket. Although most investors gravitate toward two investment types: individual stocks or stock funds, such as mutual funds or exchange-traded funds, ETF experts typically recommend the latter to maximize your diversification. While you can buy an array of individual stocks to emulate the diversification you find automatically in funds, it can take time, a fair amount of investing savvy, and a sizable cash commitment to do that successfully. An individual share of a single stock, for instance, can cost hundreds of dollars. Funds, on the other hand, let you buy exposure to hundreds or thousands of individual investments with a single share. While everyone wants to throw all of their money into the next Apple, AAPL, or Tesla, TSLA, the simple fact is that most investors, including professionals, don't have a strong track record of predicting which companies will deliver outsized returns. Reinvest your dividends. Many businesses pay their shareholders a dividend, a periodic payment based on their earnings. While the small amounts you get paid in dividends may seem negligible, especially when you first start investing, they're responsible for a large portion of the stock market's historic growth. Nifty 50 has had around 12% returns since inception, and when dividends were reinvested, however, the percentage jumped to almost 16%. That's because each dividend you reinvest buys you more shares, which helps your earnings compound even faster. Choose the right investment account. Though the specific investments you pick are undeniably important in your long-term investing success, the account you choose to hold them in is also crucial. The minimum amount required to open an NPS account is INR 500, and each subscriber can have a maximum of one account. NPS TRI is a tax-free investment exempt from tax at all stages of investment and return. The amount invested, interest earned in it, and the total amount withdrawn at the end of the scheme are all tax-free. One can take out up to 60% of their total investment after the age of 60. This 60% investment will be considered tax-free. Of course, there are certain circumstances, like burdensome medical costs or dealing with the economic fallout of the COVID-19 pandemic, that let you tap into that money early penalty-free. But the general rule of thumb is once you put your money into a tax-advantaged retirement account, you shouldn't touch it until you've reached retirement age. If you want to make money in stocks, you don't have to spend your days speculating on which individual company's stocks may go up or down in the short term. Thank you very much for watching our video. If you like it, give it like, and if you want more interesting videos like this, don't hesitate to subscribe our channel and hit the bell icon.